There is one piece of financial advice so universal, so deeply embedded in American culture, that questioning it feels vaguely unpatriotic. Your parents said it. Your grandparents said it. Every personal finance influencer with a ring light and a Roth IRA has said it. It gets repeated at dinner tables, at closing appointments, and in every adulting listicle ever written. And it is this: buying a home is the best investment you'll ever make. It's not, and I can prove it. And once I do, you're going to feel the particular kind of slow-burning rage that comes from realizing you were sold a story that benefited everybody in the room except you. Let me be clear up front. I'm not saying don't buy a house. I'm not saying renting is always better, and you should live in a studio apartment with 4 roommates while your landlord buys a boat with your money. What I'm saying is that the financial case for homeownership as an investment, not as a place to live, not as a lifestyle choice, but as an investment, is built on a foundation of selective math, survivor bias, and an industry with a trillion-dollar incentive to keep the myth alive. Which brings us to the first problem. The number everyone uses to prove homes are great investments. Because if you ask someone why buying a house is smart, they'll tell you something like, real estate always goes up. Or they'll point to their parents who bought a house in 1987 for $90,000 and now it's worth $600,000. That's a 567% return. Sounds incredible. Case closed, right? Not even close. Because here's what that math conveniently leaves out. That $90,000 house didn't cost $90,000. It cost $90,000 plus 30 years of mortgage interest, plus property taxes that averaged a few thousand a year, plus homeowners insurance, plus maintenance, which historically runs between 1% and 2% of the home's value annually, plus 2 or 3 renovation projects that felt optional until the roof started leaking. When you add all of that up, the actual total cost of owning that house over 30 years is frequently between 2 and 3 times the original purchase price. And suddenly, that 567% return starts looking a lot more like a normal equity market return, dressed up in a flannel shirt and a really good story. Robert Shiller, the Nobel Prize-winning economist who literally built the most comprehensive index of U.S. home prices in history, spent decades studying this. His data goes back to 1890. And after inflation, the average annual return on U.S. residential real estate is approximately 4% per year. Not 4%, not 14%, 0.4%. Meanwhile, the S&P 500, including dividends, has averaged around 7% annually in real terms over a comparable period. That gap isn't a rounding error. That is the difference between retiring comfortably and spending your last decade hoping the Medicare forms don't get more complicated. But here's the thing. Even that 0.4% number gives homeownership too much credit because it doesn't account for the opportunity cost of the down payment. Let's say you put $80,000 down on a $400,000 home. If instead you had put that $80,000 into a boring index fund at 7% annual returns, after 30 years that $80, 0 becomes roughly $610,000. That's money you locked into a house, sitting in a neighborhood that may or may not appreciate, in an illiquid asset you can't sell in pieces when you need cash, and that requires a contractor's cell number saved in your phone at all times. Which brings us to the mechanism nobody wants to explain to you: the 30-year mortgage. The most successful financial product in American history. Not successful for you. Successful for the institution that sells it to you. Here's how it actually works. Let's say you take out a $400,000 mortgage at a 7% interest rate, which is roughly where rates have been sitting recently. Your monthly payment is around $2,660. Over 30 years, you will pay approximately $957,000 to own a $400,000 home. That means you pay $557,000 in interest, more than the price of the house. And in the first 5 years of that mortgage, roughly 80% of every payment you make goes not toward owning more of your house, but toward paying the bank for the privilege of borrowing the money. This is called amortization, and it is a beautiful system if you are the bank and an uncomfortable one if you are everyone else. It's a feedback loop that's beautiful right up until it isn't, and for most people, it isn't for the first decade. And this isn't an accident. The 30-year mortgage was structured specifically to make monthly payments feel manageable while maximizing total interest paid. It was literally designed to be palatable. You could have a 15-year mortgage at a lower rate and pay roughly half the total interest. But the 30-year is what gets sold at closing because the payment looks smaller, and humans are notoriously bad at multiplying things by 360. Now let's talk about the historical rhyme, because this isn't the first time America has collectively convinced itself that land is the one asset that only goes up. In the early 1920s, Florida experienced a real estate boom so irrational and so enthusiastic that it makes modern housing markets look restrained. Land that was partially underwater was being sold in parcels to investors who had never visited the state. Prices doubled, tripled, quadrupled. Developers platted neighborhoods in the middle of swamps and sold them as waterfront property, which, technically, they were. People took out loans to buy land on the premise that someone else would always pay more. By 1926, prices had collapsed. The land boom turned into one of the first major regional real estate busts of the 20th century, arriving 2 full years before the stock market crash of 1929 and devastating Florida's banks before the rest of the country even started worrying. The story is not that people were stupid. The story is that when an entire culture agrees that an asset only goes one direction, the people saying otherwise get laughed out of the room until they don't. That story rhymes. Not perfectly, it never does. But it rhymes with 2005, when housing prices in Phoenix, Las Vegas, and Miami were doubling in 3 years, and mortgage brokers were handing out loans to anyone with a pulse and a zip code. It rhymes with 2021, when houses in mid-sized American cities were receiving 40 competing offers, and people were waiving inspections on homes they hadn't physically entered, because waiting was a financial strategy you couldn't afford. Here's the uncomfortable truth. The housing market doesn't behave like a rational investment market. It behaves like a sentiment market, one that is deeply structurally intertwined with credit availability, political incentives, and a real estate industry that earns 5% to 6% of every transaction regardless of whether you win or lose. When rates drop, prices go up. When inventory is low, prices go up. When institutional investors buy 15% of available single-family homes in certain metro areas and convert them to rentals, supply drops and prices go up. And through all of it, the person most incentivized to tell you that now is a great time to buy is the person who gets paid when you buy. Nobody on HGTV has ever hosted a segment called "This Was Not the Right Time to Buy." That show doesn't get made because the entire ecosystem, the agents, the lenders, the title companies, the appraisers, the staging consultants, it all depends on transactions. And transactions happen when buyers feel confident. So the industry manufactures confidence, constantly, structurally, with talking points so polished they feel like wisdom. So what does any of this mean practically? First, if you're buying a home, buy it because you want to live there, because you're staying in that city for at least 7 to 10 years, and because the stability and control of ownership matter to you. Those are real legitimate reasons. Second, run the full math before the emotional decision locks in. Not just the mortgage payment, the total interest, the taxes, the insurance, the maintenance, all of it. And then compare that to what renting and investing the difference would return over the same period. The answer will surprise you. Third, understand that the equity you build in a home is largely illiquid, concentrated in a single asset in a single geographic market, and extractable only through selling, taking on more debt, or dying. That is not a diversified investment portfolio. That's a very expensive bet on your neighborhood. Fourth, stop treating home price appreciation as income. The house you sell for a gain is also the house you need to replace in the same inflated market. Unless you're downsizing or relocating to a cheaper area, appreciation is mostly a paper number you can't spend. None of this means homeownership is a mistake. For many people, in many situations, it is the right call. But the idea that it is automatically, universally, and obviously the best investment you'll ever make, that is a marketing slogan, not a financial fact. And like most marketing slogans, it exists because someone else gets paid when you believe it. So here's where I want to hear from you. When it comes to homeownership as an investment, do you land on option A? It's still the right move for most people and the non-financial benefits justify the math? Option B, it's been overrated for decades and renting while investing the difference is the smarter financial play for more people than admit it? Or option C, it entirely depends on the market, the timing, and the individual, and the always buy narrative is the problem, not homeownership itself? Drop your answer in the comments, and let's see where everyone actually lands on this one.